Last Friday, silver hit an invisible wall over and over, right around the $74 area. And then, in minutes, it got shoved down hard. Not a slow fade, not normal two-way trade. A ceiling, a clamp, and then a sudden raid that looked like somebody kicked the chair out from under the market. If you've ever felt like silver moves different than everything else, this was one of those days where the chart doesn't feel random. It feels engineered. I'm your host, and we're going to break down what that ceiling could mean, why 2026 is turning into a pressure cooker year for silver, and what we should watch next, without wasting a second of your time. First, let's stay honest about what we know. Fact. Silver kept bumping into the same price area and failing to push through. Fact. Gold, during the same window, moved more normally, up and down, without that hard lid. Fact. After the ceiling held, silver dropped fast, like liquidity got pulled and sellers showed up all at once. Interpretation. That kind of behavior can happen in a natural market, but it's also the exact kind of tape you'd expect if someone wanted silver pinned. Now watch this, because the how matters more than the headline. When people say manipulation, they usually imagine some villain in a dark room. That's not how modern markets work. The tool is simpler: size, speed, and psychology. One common tactic is to flash huge sell orders to scare buyers, then cancel them before they fill. The goal isn't to sell metal. The goal is to move you, to make buyers hesitate, to make stops trigger, to make the crowd think, oh, it can't break higher. That's why a ceiling is so powerful. A ceiling teaches the market to stop trying. And here's the uncomfortable part. Precious metals have a long history of enforcement actions for deceptive trading. Real fines, real cases, real people who got caught. So when we see a suspicious pattern, our brains connect the dots. But we also need discipline. We can't claim we know exactly who did what from a chart. We can say this: the pattern looked abnormal, the timing was sharp, and it fits behaviors we've seen before. So the question isn't, was it illegal? The better question is, if silver was being capped, what are they protecting? And what happens if the cap fails? Because that is where the money lives. Now, let's talk about why silver is even in this fight in the first place. Silver doesn't move like a meme coin. Silver moves like a spring. You can compress it for a while, but the force builds. And 2026 is shaping up like the spring is almost fully loaded. Here are the big drivers we need to keep our eyes on, only the ones that actually move the needle. 1. The paper positioning is changing. For years, a certain group of large players leaned short. That's not conspiracy. It's visible in how futures markets are structured. Lately, we've seen signs those shorts have been reduced, and that shift matters because it changes the who panics first dynamic. If big shorts are forced to cover into a rising market, price doesn't climb like stairs. It climbs like a fire escape ladder when the building is already burning. 2. The physical market is acting like it's tight. When the paper price says one thing, but physical premiums elsewhere say another, that's not noise. That's the market telling us where stress is building. And if major refining or export bottlenecks tighten the pipe, the paper market can pretend for a while, but the physical market eventually collects. Picture a casino chip versus cash. You can pass chips around all night, but when everyone walks to the cashier at once, reality shows up. 3. The deficit story keeps extending. We've now had multiple years where demand looks like it's been running ahead of supply. That's not a one-week narrative. That's the kind of imbalance that can last, because mining doesn't react fast. A mine is not a light switch. You don't flip it on because spot price went up. It's permits, capital, time, politics, sometimes a decade. So when someone tells you, supply will fix it, our response should be, maybe, but when? And the when is what makes 2026 dangerous for anyone leaning short. Now let's do the credibility thing the right way. This is educational. We manage risk. No guarantees. No definitely. We deal in setups, probabilities, and triggers. So when you hear wild price calls floating around, don't treat them like prophecy. Treat them like scenarios. Scenario 1, the high but realistic case. In this case, silver breaks above the major ceiling levels, stays there, and physical tightness keeps premiums elevated. If that happens, triple-digit silver isn't crazy, because markets don't stop at fair value during squeezes. They overshoot. They hunt pain. But here's the detail most people miss. A 3-digit silver price doesn't just make stackers happy. It breaks systems. It stresses industrial users. It stresses dealers. It stresses short books. It stresses margin requirements. So if silver runs hard, we should expect volatility that makes strong hands sweat. You will see giant up days. You will also see savage down days designed to shake you out. That's not a bug. That's the mechanism. Scenario 2, the mania case. This is where social attention catches up late and the market becomes crowded. You see headlines everywhere. You see silver on every timeline. You see people who never cared suddenly screaming targets. Could silver hit $200 in a mania? It's possible. One risk could be that inflation expectations and currency trust collapse fast, and metals become the escape hatch. But we should be careful here. If the move becomes too fast, authorities and exchanges can change the rules. Higher margins, new limits, sudden liquidity holes. The point isn't to fear it. The point is to respect it. Scenario 3, the storm case. This is the black swan cocktail. Geopolitical stress, financial stress, and monetary stress landing at the same time. In that world, price targets that sound insane in calm conditions stop sounding insane. But even then, we don't need to worship the number. We need to watch the signals. If price is rising and physical premiums are rising, that's strength. If price is rising but physical availability improves, that's a warning. If price dips but dealers stay sold out, that's a different kind of warning, in our favor. Now let's pause on the strangest part of this whole story. If silver is so obvious, why do the related mining stocks so often look dead? This is where most people get crushed. They buy miners expecting instant fireworks, then get bored, then sell right before the move. Because miners have two enemies, dilution and hedging. Dilution is when a company issues more shares to raise cash. Your slice of the pie shrinks. Hedging is when a company sells future production at a fixed price to lock in revenue. That sounds safe until price explodes and they miss the upside. So in a true silver bull cycle, not all miners win. Some barely move. Some move a little. And a few move like rockets. The difference is simple. Do they have real ounces, real access to capital, and real exposure to spot price? Now here's the case study we've been looking at, because it's a perfect example of how asymmetric these setups can be. There's a pure silver explorer sitting on a major project in Argentina. Not a polymetallic, silver is a bonus situation. A silver story. The previous owners poured serious money into the ground, tens of millions, building infrastructure and proving the system. Then, in a deal that still makes people blink, the project was acquired for a tiny fraction of that spend. That doesn't automatically mean steal, but it does mean the upside can be violent if the drill bit confirms expansion. The resource is already sizable, tens of millions of ounces in the defined categories, plus additional inferred ounces. And here's the part that matters for 2026. The explored area is still tiny compared to the full land package. Less than 1% drilled in some estimates. That's not a guarantee. That's an open loop. Because if only a sliver has been tested, the real question becomes, what's hiding in the other 99%? Now watch the timing. They have working capital, and they're drilling right now. That means news flow. And news flow is oxygen for a small company in a hot sector. So if the metal stays strong and the drills hit, the stock doesn't need the entire market to love it. It just needs one undeniable result. But we also have to say the quiet part out loud. Exploration is risky. A company can miss, a company can dilute, a country can change the rules. So we don't bet the rent. We measure. We size positions like adults. And we focus on what we can control. Now here's the twist people don't see coming. If silver truly becomes strategic again, if governments start treating it like a critical material, then the mining industry doesn't just respond with more supply. It responds with more politics. Permits slow down, royalties get debated, export rules tighten, and that creates a weird feedback loop. The tighter it gets, the more valuable secure jurisdictions become. So when we look at any mining story, we ask one brutal question. If price doubles, does the government become your partner or your competitor? That's not pessimism, that's risk management. Here's another layer that most people ignore, and it's why silver feels possessed compared to gold. Silver is thinner, so when we see a ceiling in silver but not in gold, that difference alone can create the illusion of control. But illusion or not, the effect on you is the same. It messes with your confidence. Because if enough buyers believe it never breaks, demand cools off, momentum traders leave, and the squeeze gets delayed. Now zoom out and look at the pipe that feeds this market. A lot of silver doesn't show up as silver mines. It shows up as a byproduct from other metals. That means supply is weirdly insensitive to silver's price. If the lead or zinc business slows down, silver supply can drop even if silver is screaming higher. That's why structural deficits can last. We can't just turn on silver. We can only wait for the broader mining machine to react, and that reaction is slow. Now add the refining and export bottlenecks people keep talking about. If a country or a group controlling a big chunk of refined output adds licensing, paperwork, or limits, the global market doesn't immediately run out. It just gets delayed. Like a highway where one lane closes. Cars still move, until rush hour. Then the entire road turns into a parking lot. That's what a physical premium is, rush hour pricing. Paper says one number. Real metal says, try finding it. And when that gap persists, it creates arbitrage pressure that eventually pulls futures in the direction of physical reality. That's why we keep watching overseas premiums. Not because they're magic, because they're the early smoke before the fire alarm goes off. Now let's talk about the specific thing that makes a ceiling so dangerous: options. If there's a massive option strike sitting near a key level, price magnetizes to it like a fridge magnet. Dealers hedge, gamma ramps. Every tick becomes mechanical. So a ceiling can be defended without a single cartoon villain. It can be defended by structure. But here's the flip side. If price pushes through and holds, the same structure can flip from gravity to rocket fuel. Hedging goes the other way. Shorts chase, momentum piles in, and suddenly the market looks like it woke up. This is why we don't just stare at the line. We watch what happens after the line. Does price break and instantly snap back? That's rejection. Does it break, pause, and then grind higher? That's acceptance. Does it rip through and never look back? That's panic. And panic is where silver becomes unrecognizable. So our job is not to predict the exact day. Our job is to recognize the transition from range to escape. Now, one more open loop we need to plant right here. If the physical market stays tight and the big paper shorts keep shrinking, who is left to sell into the next spike? Because somebody has to be the other side. If the natural sellers disappear, price doesn't need good news. It needs imbalance. And imbalance doesn't knock. It kicks the door in. Now let's go back to that $74 ceiling, because it wasn't just a line, it was a message. Markets communicate through behavior, and a repeated cap says, someone really cares about this level. Maybe it's options exposure, maybe it's a big short book defending a strike price, maybe it's simply thin liquidity getting bullied. We can't see inside the books, but we can watch what price does when it returns to the scene of the crime. Because the next time silver presses into that zone, one of two things happens. Either it gets slapped down again, or it breaks through, and all the trapped positioning above it becomes fuel. That moment, right there, is where winners are made. So what should we do with this, right now, in early January? We do three things. We stop obsessing over daily candles. We focus on the pressure points: ceilings, premiums, inventory, and positioning. And we prepare mentally for volatility, because volatility is the tax you pay for big upside. Here's the mistake most people make. They think the goal is to predict the exact top. No, the goal is to recognize the regime change. When an asset stops behaving normal, it's telling you something is shifting under the surface. Now let me ask you something, and don't answer quickly. If silver was capped, who benefited from pushing it down? Was it someone protecting a short position? Was it someone trying to accumulate cheaper physical? Or was it simply the market showing us where the largest fight is happening? Drop your answer in the comments, because I want to see how our community reads the tape. And here's the second question. This one is personal. If silver goes vertical in 2026, what's your plan? Are you holding no matter what? Are you scaling out at certain levels? Or are you trading the swings? Tell us, because the truth is, most people don't have a plan until panic forces one on them. Now, one quick thing before we push into the next week. If you want more of these fast, no-fluff breakdowns, hit subscribe. Short, simple. It helps us keep building this community. All right, here's the cliffhanger we end on. That ceiling day wasn't the end of the story. It was the warning shot. Because if silver comes back to that mid-$74 zone and breaks it with volume, the market won't glide higher. It will lurch. It will gap. It will leave people behind. And the same voices that laughed at silver will suddenly pretend they saw it coming. So the next time you see silver climbing toward that level, don't just watch the price. Watch the reactions. Watch the speed. Watch the spreads. Because if the ceiling fails, the real move starts after the breakout, when the market realizes the lid is gone. And that is exactly what we're tracking next.